The topic is, or title is, Dividend Investing, a Personal Journey. Some of the subjects that will be covered is how to invest for steady income stream, common tools and techniques to build and manage portfolios, basic guidelines for managing risk. Andy is a longtime student of investing, a retiree, and has been a member of AAII for 35 years. He has been on a journey to build a steady stream of dividend stocks. To help, he draws on his management experience, his business, and engineering to construct a plan. By sharing his personal endeavor, he hopes to educate our membership on how to use dividends for retirement income. Andy spent 45 years in the high-tech industry, first in design engineering and later in senior management. His final position was as executive director of a trade association. He holds an MBA and an advanced degree in electrical engineering. And I thought Andy provides a low risk, works anytime approach to investing. And Andy, you have the forum. Thank you for presenting.
Okay.
I think it's your third time.
I know. It's really getting redundant. I'm going to share my screen here. All right. I'm not an investment professional by any means, and so everything I say, you should take with a grain of salt because I'm just an amateur trying to figure out my way through dividend investing. So, this is me looking for opportunities in stocks, dividend stocks. Sometimes you find some junk, and sometimes you find some stuff that's unjunk. And of course, the usual disclaimer, of course, is that I'm not an investment professional, and I hope that everything I say here can be taken with a grain of salt um, you really need to do your own homework. This is not something where you can expect somebody to give you some stock advice and go off and do it. We expect you to do your homework. So, just a shameless plug for the Portland chapter. I'm not involved in the Portland chapter directly. Um, I used to do the income SIG for the Portland chapter, but I dropped that just before COVID hit the whole entire country. But Todd Blickenstaff, who is our president for the local chapter here, has restructured the Portland chapter so that we are a national income and cash flow SIG group. And so he does presentations on a wide range of topics. Um, I think every month or every 2 months. So, if you want to sign up on the mailing list, just go to the Portland chapter, which is shown at the top of your screen, and um, and then enter your information, and so that way you'll get notices for upcoming meetings and so forth. All right, so quickly the agenda. I'm just going to go through some of my income goals that I've been using for the past 20 years and so forth, and the vehicles that I've used. And then I'll say a little bit about passive versus active investing, and then dividend guidelines that I use, particularly for the stuff that I invest in, and then some resources and tools. And then, of course, I'll say a few words about taxes because they do affect dividend investors. And then I'll have some closing remarks. And I've included some references in the handout material. So, if anybody wants to do some more homework, I would recommend the references. So, okay. What I'm looking for is I'm retired. I'm 88 years old. And so I'm looking for a steady stream of income. I'm not interested in growing the portfolio too much. So I'm looking for a steady stream of income, and I'd like it, of course, to grow faster than the rate of inflation, and preserve capital, um, and then optimize the after-tax income that's available to me. And I kind of try to shoot for a CAGR, a compounded annual growth rate of somewhere between 8 and 10%. The S&P 500, I think, is around 8%. So I try to do a little better than that. Uh, Although lately, I think that's been a bit of a struggle. But I'll go into a little bit more about that later on. Okay, and this is what I typically have used in the past as my income investing choices. Now, because so many topics on this income stream investing portfolio, I'm just going to concentrate on dividend investing right now. There's obviously all these other approaches that can be used, and you're welcome to try some of them. The more you learn about them, the more you'll see that that's a benefit to you. So I'm going to just concentrate on dividend investing right now because that's the simplest and the straightest forward way to invest in and get a steady stream of income. And all these other approaches are perfectly fine too as well. Um, and just a quick note about the approach that I use. There's kind of, I think, four ways of investing for income. You can use what's called a passive approach, which is, you buy a mutual fund or an ETF and then you monitor it and do some work on that. And then some people use a combination of a newsletter, dividend newsletter, for example, and then they use a passive style by just investing what the newsletter requests or tells you to do. And then there's a more proactive style, which is what I tend to do over the years. And it's really, really important to keep accurate records. And then I usually kick the tires on my stocks twice a year, maybe even quarterly on a quarterly basis. So I tend to be on the more proactive side. And so um, weekday mornings, I'm at my computer, kicking tires on various stocks and trying to figure out what's undervalued and what's overvalued and so forth. Okay, so I'll just go over these um, ETFs because I do have some ETFs. In fact, since I have an account with Schwab, I use the SCHD, which is their dividend um, ETF, and it's fine. I mean, it works fine. The problem with it, of course, like any ETF, is that you take the good and the bad when you're buying an ETF, and so it gives you an average performance, which is fairly close to the S&P 500. So um, what I try to do is I try to buy it when it's undervalued. And so I do have some portion of the portfolio, which is in SCHD, but I'd say it's a fairly small percentage of the entire portfolio. But for a passive investor, ETFs are fine. I mean, they're a good way to go if you don't want to spend the time on it. So, okay, and then quickly, just to give everybody an overview of what these ETFs will do. Um, if you looked at the S&P 500 and you looked at just the aristocrats, which are the dividend stocks that I think have been um, paying dividends for the past 25 years or so. For example, Nobel, which is NLBL, it does that very well. And you can see that here that they do beat the rate of inflation quite a bit, by quite a bit. And so they're a good vehicle for a retiree. And they do compensate you a little bit for inflation and so forth. Okay, so let me take a moment here to make sure everybody understands what a portfolio of stocks would is made up of. I think that corporations, if you looked at all 47,000 of the companies that are available, publicly available, there's only a fraction of that which are what I would call mature companies. In other words, there are companies that are uh, startup companies on the left here, and then you have your growth companies, and then the mature companies are at the peak here, and of course there's companies that are actually in decline or are going to close out their businesses basically. So when you're looking at a dividend stock, I tend to concentrate on the mature companies. These are people that are, these are like AT&T or Pepsi or Hershey's or Procter and Gamble. They're not companies that are startup companies or growth companies. I would consider, for example, Nvidia, a growth company and a great company, of course, with great opportunities and so forth. But you want a steady stream of income, and these growth companies tend to be plowing back a lot of their capital back into the business so that they can grow. Whereas mature companies tend to be mature and they're already established in their structure and so forth. And so to that end, the revenue growth is pretty much the close to what I would describe as the maturity of the firm. These companies have a tendency to grow at somewhat around the economy. In other words, they'll grow 5 to 7% or 8% per year. Their margins are well established, so they tend to have some sort of a competitive advantage of some sort, and it can be, um, a significant competitive advantage as they move forward. They tend to borrow more money than the typical startup company or growth company. And it's because they're more attractive to banks who want to lend money because they're a little more steady in terms of their cash flow and so forth. So they tend to borrow a little bit more money. Um, and the cash buildup in these companies is fairly large, and that's why they pay dividends. In other words, they build up their business. Um, they end up with more projects that they can't find enough projects that will cover their hurdle rate, so to speak. And so that's where where the dividend comes in. And so they generally provide cash back to the shareholders, either in the form of actually of a dividend or a buyback, basically. And they tend to be inorganic growth. So they tend to, a lot of these mature companies will pretend like they're teenagers and go out and buy other companies, or they may sell a division that is not profitable for them and so forth. So that's typically the characteristics of these mature companies. Okay. Um, the way I go approach a company or do an investment is I use what's commonly called the discounted cash flow approach. In other words, what I do is when I look at a particular company, I look at the cash flow from the company. Either that's in the form of earnings or in the form of dividends. And so what I'm trying to do is to take the cash flow that may be in, say, year one and year two and year three, and I discount it back to the current price or current value. And this discounting process is gets fairly technical, but it's basically an approach that uses what's called a valued approach or a fundamental approach. So in other words, you're buying an entity and you're looking at this future stream of cash flows and you're discounting it back to the current day price, and then you determine whether that's undervalued or overvalued. And so I use two approaches. I use what's commonly called the discounted cash flow, which is basically looking at the present value of the cash flows that the company has. And then the other approach I use is I use the dividend discount model. Um, the dividend discount model is simply you're looking at the uh, dividend operation from the company, the cash flow, the free cash flow from the company, determining how much of that free cash flow is going to be distributed back to the shareholders. And then I try to estimate how much that cash flow will grow over a given period of time. Usually about 5 years as best as I can do. Um, Now, a word of caution about doing this kind of modeling. Every time you do a model, you develop a spreadsheet or whatever, you're going to be wrong. It's just there's no way about it. No way about it. For example, uh, recently I saw an analysis of Pepsi done by a professional analyst community, and every one of the estimates for the stock, the price on the stock, the valuation was off, was different. And that's because there's so many variables that can be that are judgmental variables. It's difficult to get the exact number. And so you need to revisit your portfolio and your stocks on an ongoing basis. And so that's what I do. I look at them usually on a quarterly basis or semi-annual basis. Now that doesn't mean you have to look at every one of them. Just the ones that are where you think you may not be achieving the growth rates or the rates of increases that you want. And so I'll go over a little bit more on that a little later. So here are my guidelines. I try to go for a growth rate somewhere between 9 and 10% if I can get it. That's a little difficult to do in today's market, but in the past, it's been quite achievable. And then I use primarily dividend stocks that are probably paying somewhere between 2.5% to 3% yield. And then I try to find companies that will pay, somewhere between 6 to 8% in the growth of the dividends. So in other words, the combination of the growth and the yield is somewhere between 8 to 12%. If I can find that, I'm a happy camper, so to speak. So, and then I allocate the portfolio. My rule is somewhere between 2.5 to 3.3% of the portfolio is in any given stock. Many years ago, when I was still working in Silicon Valley, I bought Intel in the 1980s, of course, and of course that in those days Intel was doing very well. So it became a huge part of our portfolio, and so I had to sell a lot of it to get myself down to 2.5%. So that can happen to you if you're buying a stock that has a large growth rate. And then I try to diversify across industries and sectors. Uh, um, I usually try to do this on a portfolio basis, and so this is kind of beyond the scope of my presentation today, but I can go into that sometime in the future if needed, if we can talk about that. And then I try to keep the portfolio to somewhere between 25 to 30 stocks or entities, mostly dividends. I do have some REITs. I have income realty basically, and I've had some MLPs in the past. And I do own some preferreds. Um, I find preferreds to be a very, very attractive area right now. Yeah, but I won't go into too much there because that's an hour's presentation all by itself. So, but the portfolio is mostly dividend stocks. Okay, here's the guidelines. I the past dividend growth is suggests the performance. In other words, these companies are mature companies, and so they'll grow their dividends, approximately the same rate at which they've done in the past. Um, there's some variation on that because you have to look at the free cash flow to make sure that they are now continuing that. Some companies can get into trouble. Um, and their cash flow can drop dramatically. Um, and then just to make sure everybody understands, there are some tax implications with dividend stocks because the bottom line is how much money do I put in my own pocket so that I can spend it on, what my life, so to speak. And so if you're buying a dividend stock and your tax rate, let's say, is you're in the 15% tax bracket, then, oh, excuse me, in the 22 to 24 tax bracket, and you're filing on a joint return, that dividend is taxed at 15%. That's quite a bit lower than what you would normally have for ordinary income. And so dividend stocks, qualified dividend stocks, are a fairly attractive approach for a retiree. And if you're doing it in a tax exempt account, well, of course, that's even better yet because it's untaxed until you actually take your RMD. So dividend stocks are a very attractive approach for an investor, especially a retiree. Um, and then I have some selling criteria here that I use for dividend stocks. If they cut or suspend the dividend, then I'm out basically. Usually, and then if I look like the stock is going to be in a bubble, so to speak, then I'll dump it basically if it's fairly high and overvalued. Um, and then if there's a fundamental change in uh, the company, I'll do it. For example, I was looking at Hershey's. Hershey's. I don't know if you follow that particular stock. Is that they get most of their cocoa beans from West Africa, and the weather there, I guess, had an extreme situation, and so the suppliers of cocoa beans declined dramatically, and so of course Hershey got impacted by that, and so it forced me to sell that particular stock, which was a very attractive dividend paying stock, and so that kind of fundamental major issue can really impact you and so forth. If they announce a split or separate entities, I generally see that as a flashing red light or a warning, a yellow light. And so I take a hard look at it because, if they spin off some particular division, uh, that division might be one that is very profitable or maybe one that they don't want to or has marginal results. And so you have to take a look at it. If the cash flow dips, I I take a very hard look at it. Probably the most important one on this list is the management. If the CEO uh, leaves the company for whatever reason, or the CFO leaves, that's a flashing yellow light in my judgment, because you don't know who is going to be taking over, and you never know for sure how they're going to manage the overall direction of the company. So I usually watch that very carefully. Um, if the yield drops below 2.5%, or is above 9%, then I take a long, hard look at it, because um, I think that's, you know, I don't like chasing yield, basically. Um, and if the current yield exceeds 10%, it's generally I just drop profit from the portfolio. I don't use any margin. I don't use any shorting. I have done some options in the past, covered calls, and I may do that in the future. Um, but I don't do anything right now, to be perfectly honest. And I certainly don't use futures. Um, and I review the portfolio maybe 4 times a year. Okay, so here's where I get my resources. I subscribe to some of the newsletters. There's a Morningstar newsletter called the Dividend Investor, which is pretty good. I subscribe to that one. I subscribe to the AAII one. I use Seeking Alpha quite a bit. And then I use the Kiplinger Income newsletter. And the local library here, um, um, in the Portland area. I see this is backwards. This icon makes available value line for online for all members of the library. And so I use that quite a bit, and once a week they'll publish 2 portfolios, one for high income and one for steady growth portfolio. And so take a look at that every week and see if there's anything new there that might be attractive and so forth. So, okay, here are my tools. I use Quicken Premier. And to be perfectly honest, it's kind of a love-hate relationship. It's kind of a bookkeeping system. It keeps track of my equities and all the dividends that they pay. And basically, what I do is I set it up so that it goes out to the brokerage accounts and pulls in the transactions for all 30 of the stocks in the portfolio. One other thing that I like about Quicken Premier is that it uses what's called an IRR calculation. And that's very, very important when you're doing dividend stocks. In other words, what the internal rate of return is that if you buy a stock and then you have a stream of dividends that come to you, and then there's the current price of the stock, that internal rate of return is very, very important, because that has to be, for me, at least 10% or better. And so Quicken allows me to do that very, very quickly. I just go out there and have the brokerage if it fetches the information from the brokerage account and tells me right away uh, if a particular stock is in trouble or something in terms of cash flow. The Value Investing IO program is a discounted cash flow program. In other words, what it does is it allows you to download a spreadsheet with all the requirements, all the fundamentals in it, so that you can do a discounted cash flow to dividends or discounted cash flow to equity. And so I use that pretty regularly when I'm trying to value a stock. Seeking Alpha, I think many of you are familiar with that. It has lots of places that you can go to. For example, a lot of analysts publish information there, so you can go to a particular stock and look at what the analyst community is saying about the stock. I use it pretty regularly. And then one of the important other, well, I use Fast Graphs, which is a fundamental analyzer tool. That's a very good program. I highly recommend it for anybody who wants to do any kind of investing. And then, of course, I use Google Sheets or Excel. And I have a Schwab account. And so if I'm buying or selling a particular stock and I want to find out what the technical indicators are, I use the market edge portion of the Schwab account to track what's going on there. And then, of course, I use TurboTax. Lately, I've been using Gemini Advanced. I signed up for that. And what I use that for is primarily the quickly accessing the management statements and their forecasts of what's going to go. I just plug in the company's name and what its estimated commentary is, and it comes back with what their latest version of what they think is going to be happening. So it's been a helpful tool. Just a quick note on I keep a journal. The journal is a little dated now, and it's a kind of it used to be a loose leaf binder where I had one each stock. And then what I would do is I would write down why I bought this stock and why and when I would sell it. In other words, I would write that down the first day I buy the stock. In other words, I would buy the price I would buy it at and what my line of reasoning was. And then also at the same day, I will write down when I would sell the stock if I got into trouble and it was not working out the way I thought it would be. And that's worked very well because it gives you a perspective on a particular stock, and you learned quite a bit from doing that. I'm trying to migrate that over to Notebook LM. So quite frankly, the jury is still out on that in terms of trying to do that. Maybe sometime in the future we could talk about that. But right now, I find that Notebook LM is a very good possible source, because it's a repository of information that you and only you have access to, and it does all the AI analysis that you want it to do. And I put in there a lot of fundamentals as well, not just the journal stuff as well. Okay, just a quick thing on the taxes. I've flagged Oregon has a very high tax rate, 9.9%. So if you're in a 24% bracket, let's say, and then or you're buying dividend stocks, and your dividend stocks are taxed at 15%, you have to remember that Oregon is another 10%. So that's 24% of your income is taxed basically from your pocket. And so that's a big issue. And that's probably true for some of these higher high income states as well. California probably is one of the highest. So take that into consideration when you're doing your analysis on stocks. Just to finish up here, thing. This is a chart that comes from David Lebson's journal at the AAII journal in 2011. And basically, and I've noticed this with some of my older friends, their mental capacity does decline. And so you better have a migration path that allows you to move your portfolio to someone who's more qualified and competent to to handling the portfolio if, God forbid, you're ever at a point where you cannot manage it yourself. And so I highly encourage everybody to figure out what they're going to do about that. Maybe it's somebody else in the family, or maybe it's a professional advisor, but you need to have some kind of a way to do that on a regular basis. Just you don't know what's going to happen in terms of when you get older. Okay, closing remarks. Uh, I think it's important to be patient and realistic. Um, there are some risks involved. The higher you go, the higher you go in yield, the more you're going to be more risky, and it will be more volatile. Um, and there are medical expenses that will come up that I'm sure you've never anticipated, and so you need to be prepared for that. And taxes don't disappear; they continue to affect you. Well, that's it. I don't have anything else. Hope that wasn't too much time. Um, I'm happy to take questions, but
Um, so thank you, Andy. That was a very helpful presentation, and we do have a few questions in the chat. Um, the first is, I have AT&T, which was left to me by my mom 15 years ago, and I believe Motria, is it MO, which I bought a year ago or so, at a 10% yield. Both have appreciated a lot. Can you tell me what you would do in these cases?
yeah, I own AT&T myself, and I also own Verizon. And AT&T, it pays a very, very nice dividend. I think it's like 7 or 8% now, I think. And the problem with AT&T and with these utility companies, especially communication companies like AT&T, is they're heavily leveraged. They borrow a lot of money, and so they use that leverage to make their business more competitive, so to speak. I continue to own AT&T. For a while there, I thought I would sell it, but as long as it provides me a cash flow, I'm fine. The company has recently started to reduce their debt structure quite a bit. They sold DirecTV, I think, which was a chain around their neck, so to speak. And so the result of that sale is they've slowly started to reduce their debt, and so um, they're much better shape now than they were a couple of years ago. Now, turning to Verizon, Verizon hasn't got is still heavily leveraged, and that is a problem. Uh, the valuation on that, the dividend is very attractive, of course. It pays a nice dividend. But in terms of valuation, frankly, for me, it's underwater. And so if it reaches a point where the internal rate of return for that particular stock drops below 10% for me, then I will probably sell it. But AT&T, I'm continuing to hold, to be perfectly honest. Thank you.
Got it, Andy. Can you comment on Altria or Philip Morris?
I don't have Altria. Um, I have not looked at it. And Philip Morris, I don't have either. They are both very attractive dividend paying stocks. Um, I have friends who own them and have done very well with them. So I can't really give you any advice on that.
All right, thank you. Our second question is, um, which discounted cash flow analysis tool do you use to value a stock?
I use two. I use the free cash flow to equity, and then I also use the dividend uh, cash flow to and the problem with cash flow analysis is the terminal value, the year 5. What you assume will be the cash flow in year 5 can cause a huge variation in the present value of a particular stock. But I use both. And then as a sanity check, I will check it against what the investment community says is the value of that particular stock. For example, Morningstar has what they're called their 5-star rating. If you go to Morningstar and you look at their 5-star rating, that's the deepest discount price that they think that the particular stock should be bought at. So I use that as a threshold. And then I may look at Seeking Alpha. I may look at some of the analysts there to see what they're doing too as well. So there's no one number. You just kind of have to look at the range and see. I tend to be very conservative, and so I tend to go close to as low as possible as I can. And I look to see if there's a bottom forming in the stock, and then I'll buy it.
Got it. And someone mentioned there's a site called valueinvesting.io. I don't know if you've heard of that or have any opinions about that site.
Yes, I do. I use value investing. I think it was mentioned in my presentation.
Okay, got it.
Yeah,
Perfect.
It's an excellent site. I use it every day.
All right. Could you expand on how you handle RMDs with your dividend allocation? And do you handle non-retirement versus retirement accounts differently within the dividend allocation?
What I do is I generally put the MLPs and the REITs in my tax-exempt account. And the reason for that is because MLPs and REITs pay their dividends, and those are not qualified dividends. They're dividends as ordinary income, and so they're taxed at your normal rate. Let's say if you're in the 24% bracket, you would be taxed on those at the 24% level, and then your state adds another 10%. So you're talking about 34%. So I tend to put those in my tax exempt account, whereas the dividend portfolio is more in my non-taxable or my taxable account, basically.
All right. There's another question that says, can you explain more on how to achieve a sustainable yield on cost?
Well, if you buy a dividend stock and the dividend grows at a regular basis, then your yield on cost will go up. There's an analyst, excuse me, that analyst who talks about, let's say you buy Procter and Gamble and it pays a 3% dividend, but the dividend grows at, let's say, 5 or 6% per year. When you get out to that 10th year, let's say, then your yield on cost is about 10%. So, but the assumption is that your dividend is growing every year, year in, year out, as you reach that 10-year period. So in other words, the best time to buy a dividend stock is when you're in your 50s, okay? And so if you buy a good solid dividend stock in your 50s, by the time you reach retirement, your yield on cost will be somewhere around 10%. And that's very, very, and of course, you don't take any money out of that dividend. You reinvest the dividend, of course, during that period of time. So it's an ideal vehicle for people that are approaching retirement, say they're in their 50s, that can be a fantastic deal. If you pick a very conservative company, you know, Johnson and Johnson or Procter and Gamble or Hershey's or whatever. These companies they they will pay their dividends on a regular basis and year in year out. Any of the aristocrats are a good deal. That's why SCHD is such a fantastic ETF. Yeah, good.
Thank you. There's a question about the way that you approach your portfolio, whether someone else can take over for you when you need them to.
Yes, I have it structured to be perfectly honest. There's two parts of the portfolio. One part is fixed income, and what I did there is I have an account at Schwab, and what I do is I said, okay, Schwab, the fixed income portion of the portfolio, I would like you to manage for me because doing bond analysis is is a lot of work, to be perfectly honest. And so I said, well, let's negotiate a fee for that. And so they came up with a a servicer that does that bond portion of the portfolio. So now that's already established. I did that about a year ago. Okay. So now if something happens to me, you know, whatever, I can easily say, okay, take over the other part of the portfolio, and they can do that fairly quickly. And I've done all the evaluation on their advisor. I hopefully, they'll do a good job. They tend to be right down the middle of the road. They don't tend to be too far to the left or too far to the right. Uh, they're what I would characterize them as probably the S&P 500 in terms of their growth rate. So, for a legacy of portfolio, that's probably okay. And so I'd like to obviously have them do better than that, but that's very difficult to do. So,
Thanks, Andy. And then there's a question about anyone using TurboTax. Have they noticed that it does not separate qualified dividends from regular dividends?
no, I think it does. Um, I That's a good question. I don't think as far as I know, when you get a statement um, from your brokerage house, it will tell you which dividends are qualified dividends and which ones are not. Your 1099 will tell you that. As far as I know, yeah. I use
Okay.
TurboTax all the time, and it's it does that fine. I don't see that's an issue.
All right. Well, thank you for that. My husband does the taxes, so I don't know that question. But there's a couple of more comments and a couple more questions. The first comment is Simply Safe Dividends is a good tool for evaluating dividend paying companies. It rates safety of dividends and provides warning of any risks. I don't know if you have any comments about that.
Yeah, a lot of my friends use Simply Safe. Yeah, it's good. It's a good approach. Yeah, I just don't use it. Um, they if you don't want to spend the time doing the analysis yourself, Simply Safe is an excellent choice.
Got it. And then the other comment was someone sharing their investment philosophy that they don't buy stocks solely for the dividends because some of the folks with high yielding um, dividends might be kind of, not worthy of investing in. And they gave, some examples, but I don't know if you have any thoughts on how to avoid the dogs.
Yes, that's correct. There are dogs in the dividends. That's right. Um, the free cash flow is the primary vehicle. In other words, you look at the free cash flow and you want the dividends to be the dividends and the buybacks be less than 50% of the free cash flow. That's a rough rule of thumb. So yeah, if the free cash flow takes a dive for whatever reason, then that's a flashing red light. You need to take a look at the stock and say whether I want to continue holding it or not. Um, yes. So buying a stock where the dividend is say up to 9 or 10%, that's that's not going to happen. That's just not going to long term. That's not going to occur because what happens is everybody rushes to buy that stock. The stock drops in price, so uh, it's not sustainable. Let's put it that way. So buying a high dividend stock is just waiting for something to happen, a problem to happen. Because let's face it, if your risk-free level of investing is, let's say, 4%. In other words, you can buy a bond, a 10-year bond at 4%. Why would you want to buy a dividend stock that pays 10% when that risk parity is huge? There's what's called a risk premium, equity risk premium, that we could go into. It's a totally another subject that tells you exactly how much risk you have in a particular stock. And that risk premium is very, very important. It's actually basically the discounted cash flow that a company does. When a company starts a project, they go through all this discounted cash flow. They do basically a hurdle rate, and that hurdle rate is what's called the weighted average cost of capital. And so you need to know what that is for the company.
So the last question I have here is, may we email you, Andy, for additional questions?
Yeah, sure. You can. It's Andy Profit, uh, the number nine at gmail.com.
All right. Well, thank you.